Hi guys, this is Yajin and welcome back to my channel ACCA and Beyond. In this video, we are going to be continuing with our revision series, and today's chapter is going to be chapter number 10, Procedures. I'm warning you all in advance. This is a bit long chapter. I might divide it into 3 parts or 2 parts. I'm not yet sure, so let's see where it goes. Okay, so this chapter focuses on the practical application of audit evidence, and audit procedures should always be designed on the specific risk of material misstatements identified for each client. In exam, this means your answer must be tailored to the scenario, not generic. For example, if the risk relates to inventory valuation or receivables recoverability, your procedure should directly address to those areas. Generic answers won't fetch you any marks. The auditor's main role is to obtain a sufficient and appropriate evidence to ensure that financial statements are prepared in line with the relevant reporting framework. This is why a strong understanding of accounting standards is essential. When writing audit procedures, clarity is key. Each procedure should clearly state the action to be performed, the source of evidence, and the objective being achieved. In simple terms, what to do, how to do it, and why is it being done. A good way to check your answer is to read it back and ensure that even someone with no audit knowledge can understand it easily. So let's understand what makes a good audit procedure with examples. So for testing the existence of non-current assets, a strong answer clearly explains everything: the source, the action, and the objective. For example, selecting a sample from the asset register and physically inspecting them to verify existence. On the other hand, a vague answer like check a sample of assets is incomplete. It doesn't explain where the sample comes from, how to check it, or what exactly is being tested. Now, for receivables, it's important that the procedure matches the audit objective. If the audit objective is valuation, a good procedure would be to inspect post-year and bank statements and confirm whether payments have been received, then match them to the receivable balance. However, sending confirmation requests to customers text existence, not valuation. So even if it's well written, it's relevant not to the objective. If you guys have been have problems identifying audit assertions, I already have a video on that. You can just search on YouTube about it, and it's a very helpful video, I guess. So yeah, you guys should definitely watch it. So this shows an exam that it's not just about writing a good procedure, it must also directly address a specific assertion being tested. So this chapter introduces basic auditing techniques to help you apply them in question. um, so there are different ways to design audit procedures, and all start with understanding what exactly you are testing. First, identify the financial statement assertion. For example, to test the accuracy of sales, the auditor should match the sale invoice amount with sales records. Next, identify the source of evidence. In payroll, this could include pay slips, which can be checked against payroll records. Auditor can also use different types of procedures, such as analytical procedures, for instance, calculating the receivable collection period and comparing it with prior years to spot unusual changes. Another important concept is directional testing based on double entry bookkeeping. Even debit has a corresponding credit. This helps auditor avoid duplication and work more efficiently. When testing for understatement, the auditor should check whether all transactions are recorded and correctly valued. To do this, the sample should be selected from outside the accounting system and traced into the financial records and financial statement. This ensures that nothing is missing and the amounts are recorded accurately. To test for understatement, the auditor starts from outside the accounting systems and traces transactions into the records. For example, selecting I'll just write it outside to inside. This is very confusing. Even I got confused. So yeah, it's better if you learn it. And for example, selecting goods dispatch notes and tracing them to sales invoices and then into sales listing ensures that all sales are recorded. Testing completeness. The total sales listing is then agreed to the revenue figure in the financial statements. On the other hand, overstatement occurs when items are recorded that shouldn't be included, or are recorded at higher amounts. Testing for overstatement focuses on assertions like existence and accuracy. Here, the direction is reversed. The Can you guys just give me 1 second? Yeah, so the direction is reversed. The auditor starts from the financial statement, agrees the figure to the accounting records, and then selects a sample to trace back to the supporting documents. For example, agreeing revenue in the financial statements to the sales listing and then tracing selected invoices back to supporting evidence ensures that recorded transaction actually exist. This highlights an important exam point. The direction of testing depends on whether you are testing for understatement or overstatement. For bank and cash, the key assertions are existence and valuation. If you could note it down somewhere. The auditor needs to ensure that the cash actually exists and is recorded at the correct amount in the financial statements. There are several important sources of evidence, including bank statements, bank reconciliations, the bank ledger, and the bank confirmation letters. The bank ledger balance is the figure included in the financial statements, but it may differ from the bank statement due to timing differences. That's why the bank reconciliation must be reviewed to ensure all differences are valid and properly explained. One of the most reliable pieces of evidence is a bank confirmation letter. This is independent, third party confirmation received directly from the bank, making it highly reliable. However, the client must give permission to the bank to share the information due to confidentiality. The confirmation request should be sent in advance, usually at least 2 weeks before the year end, and must include sufficient details for the bank to identify the client. The response is then directly sent to the auditor, ensuring authenticity and reliability of the evidence. I am going to skip this part. Yeah. So, when cash is in hand, it's significant fraud or error is suspected. The auditor should perform a cash count to verify existence. All cash balances must be counted at the same time to prevent any manipulation between locations. The auditor should also be accompanied by a member of the client staff to avoid any allegations of misconduct. Details of the cash count must be properly recorded, including locations, amount owed, staff present, the auditor involved, and the date. Moving to non current liabilities, the key assertions are completeness and valuation. The auditor must ensure that all loan balances are fully recorded and correctly. It's given away. Yeah, sorry. So the auditor must ensure that all loan balances are fully recorded and correctly valued in the financial statements. It is also important to check the classification. How much is due within 1 year as a current liability, and how much is long term. Evidence for this includes loan agreements, bank statements, bank ledgers, and bank confirmation letters. The bank confirmation letter is especially useful as it provides independent details of loan balances, interest, and overall security attached. Overall, the third party evidence like loan agreements and bank confirmations adds strong reliability to the audit process. Let's look at the key audit procedures for non current liabilities. First, obtain a breakdown of all loans at the year end. Check the calculations and agree the total to the financial statements to ensure completeness. Next, agree the loan balances to the bank confirmation letter to verify accuracy, valuation, and rights and obligations. Also, check if there are any loans in the confirmation letter that are not recorded in the financial statement. This helps identify the completeness issue. The auditor should inspect details of any security on loans and ensure proper disclosure in the financial statement. It's also important to review disclosure like interest rates and the split between current and non current liabilities, ensuring correct classification and presentation. Recalculating this split is essential, especially if any loan convenience have been breached, as this may require the loan to be classified as a current liability. The loan agreement should be reviewed for such terms and their impact. Additionally, inspect the bank ledger for repayments made to confirm existence and accuracy. Finally, recalculate interest expense and accruals based on loan agreement to ensure the finance costs are complete and mathematically accurate. For non-current assets, the key assertions are existence, valuation, completeness, and rights and obligations. This means assets must usually exist to be fully recorded, be valued correctly, and must belong to the business. There are several important sources of evidence, including the assets register, purchase and sales invoice, physical assets, ownership documents, revaluation reports, and bank records. The auditor needs to gather evidence across different areas: existing assets, new additions, disposals, revaluations, and depreciation. For existing assets, physical verification helps confirm existence. Additions can be checked using purchase invoices and supporting bank payments, while disposals are verified through sales invoices or disposal records. Revaluation should be performed by reports from independent experts, and depreciation must be reviewed based on companies' policies and useful life assumptions. Finally, the auditor must also review related disclosure in the financial statements, including asset notes, depreciation methods, and revaluation details to ensure they are complete and accurate. Yes, okay. So for intangible non-current assets such as development costs, the key assertion is existence. This means that the auditor must ensure that the cost capitalized actually relate to genuine development activities. There are several important sources of evidence, including a breakdown of development expenditure, purchase invoices, and bank records to verify payments. Timesheets can also be used to confirm that employee time has been spent on development activities. Project plans, test results, and cash flow forecasts help support whether the project is viable and meets the criteria for capitalization. Additional evidence may include license agreement and third-party valuation reports, uh, uh, or especially for assets like brand names or trademarks. Finally, the auditor should review amortization policies and rates to ensure that the asset is being written off appropriately over its useful life. Development costs can only be capitalized if they meet the recognition criteria under IAS 38. So the auditor's focus is to ensure that the criteria is properly satisfied. First, obtain a breakdown of capitalized costs, check the calculations, and agree the time total to the financial statements. Then, for a sample of cost, verify the amounts using invoices or timesheets to confirm valuation. To support existence, the auditor may review board minutes and discuss the project with management to understand its purpose and progress. Project plans, supporting documents, and budgets should also be inspected to confirm technical feasibility and financial viability. Disclosures in the financial statements must also be reviewed to ensure compliance with IAS 38. For other intangible assets, purchase documents help confirm ownership and cost, while valuation reports support the carrying value. Finally, amortizations must be checked. The auditor should assess whether the amortization period is reasonable based on expected future benefits and recalculate the charge to ensure accuracy. For assets like license, the amortization period should match the license duration. So I'm going to stop here for today's video. If you like this video, please like, share, and subscribe, and share it with your friends. And thank you so much for watching.